My name is Kiala Smith, a finance educator, and today we're going to talk about why investing in index funds is a superior investing option for most investors as opposed to investing in individual stocks, such as buying individual stocks in maybe Disney, Apple, or Coca-Cola. But first, let's talk about what an index fund is. Let's lay that fundamental groundwork first, and then we'll get to 5 benefits of investing in index funds. Okay, first we're going to break down what a stock index is. And index is a singular form of the word, but if you're referring to multiple, it's called indices. Now, a stock index is a group of stocks or other investments that represent a segment of the entire stock market. Think of it like this. Let's say there are 1 billion working adults around the world. But I want to know how many of those adults are maybe in the United States, or maybe just in the state of Florida, or how many adults are nurses. Each one of those are segments of the whole population of working adults, and there can be varying levels of specificity. Now, a stock index does the exact same thing, but instead of working adults, we're going to use companies. A stock index is going to measure the performance of certain subsets of the entire stock market. So some of these indices will be based on location, technology base, size of the company, or whether the company pays dividends or not. 3 of the most popular indices are on the screen right here: the S&P 500, the NASDAQ, and the Dow Jones Industrial Average. Now, the first one, the S&P 500. This is going to contain the top 500 companies in the United States and represents about 80% of the United States stock market. This is probably one of the most popular indices that people are using to invest in today. Now, the NASDAQ contains mostly tech stocks. So if you think of all the tech companies out there, they're likely on the NASDAQ. And the NASDAQ is one of the oldest traded indices in the world. Last but not least, the Dow Jones Industrial Average. So the Dow Jones Industrial Average is the oldest and most frequently used index in the world, but it only contains 30 companies. These are the largest and most influential companies in the United States. There's actually a whole committee that gets together and decides who are these top 30 companies going to be. And yes, you can move in and out of different indices. So if there's a company that's no longer as popular or as large, maybe they split, they can be kicked out of the Dow Jones Industrial Average and go to another stock index. Now, if I only wanted to invest in U.S. companies in the United States, I can invest in the S&P 500 index, which will contain a collection of all of the 500 companies in the S&P. Or, likewise, I mentioned if you want to just invest in tech, you will find you an index that mimics the NASDAQ. Now, we can really think of an index fund as a layered cake. Each layer is a company, right? So there's someone who goes out and says, all right, these are the top 500 companies in the S&P 500. I'm going to mimic this index and create a fund of my own. Whatever 500 companies they have, I'm going to have in my fund too. So they are assembling this layered cake, and each of these layers is a company. Now, once this cake is assembled, then investors like ourselves are able to invest in these companies by buying a small slice of this very large cake. Now, when we buy a slice of this cake, we are really getting a small piece of all of the companies in that index fund. So if it's an index fund that mimics the S&P 500, when we buy a share of that index fund, then we're going to get exposure to all 500 companies. But why is that a benefit? Let's take a look at a quick example. Let's say instead of buying an index fund, I decided that I had $300 to invest, so I invested it across 2 individual companies. I invested in Apple and I invested in Coca-Cola. Okay. Now, what if next year one of these companies starts to underperform. Maybe Coca-Cola isn't having a stellar year and the stock price is drastically down. This can have a huge impact to my portfolio, as you can see. But if we had bought an index fund that had tens, hundreds, or even thousands of companies contained within it, then I have instant diversification. So if one stock underperforms, I'm not going to lose my shirt. My portfolio is not going to be drastically reduced in value. So you have the benefit of diversity. So that's a good brief introduction to what an index fund is. And now let's go into what are the benefits of owning an index fund over these individual stocks. So if you caught one of the benefits, I already mentioned one, but let's start at the top of the list. One, index funds are really a hands-off investment. And I think that's what most investors are looking for, something that they can invest in and they don't have to regularly monitor how it's doing. Whereas when we invest in individual stocks, such as maybe a Coca-Cola, a Disney, or an Apple, we kind of feel the urge to kind of check on how's that stock doing, because if that stock starts to decline, that's going to have a really big impact on our portfolio. Whereas when we invest in hundreds or thousands of stocks at one time, if one is not doing well, it's not a big deal. This is truly an investment that you can continue to invest in regularly, and you don't have to really check up on it. Number two, second benefit, index funds are what's called self-cleansing. All right, because companies will come and companies will go. Companies will merge, companies will split, some will go out of business. And if we own individual stocks in those companies, that may be something we need to be on the lookout for. But not when we own index funds, because they are self-cleansing. As companies come and go, the index fund will update automatically without you having to do any extra work. Number three, this is the one that I mentioned in the previous slide. Diversification. Diversification is key to having a healthy portfolio. Having diversified stocks across different stock sectors and different price points and industries is really going to benefit you on the long run. Because sometimes there's events that affect different sectors of the market, such as when the pandemic happened, a lot of the hospitality industry was very hard hit. If you had only invested in that industry, your portfolio would be destroyed, right? So diversification is key to keeping our risk low and our profits high, okay? So index funds automatically give you exposure to lots and lots of companies without having to buy in each every one of those companies individually, which could be much more expensive than just buying an index fund. All right, benefit number four, index funds can capture the segment of the market you wish to invest in. Now, if you are interested in investing in companies in the United States, then the S&P 500 index is probably a benefit to you. If you are interested in investing in tech companies, there's an index fund for that. If you are interested in investing in American companies that pay dividends, there's an index fund for that. So there's so many funds out there that you can invest in that specifically goes towards your target market, but still adding diversification in there. If you're already investing in maybe your 401k or an employer-sponsored account, you're already investing in index funds. Those are all index funds. And a lot of them are targeted towards when you're going to retire. So they already have they're already capturing a segment of the market as well as maybe a segment of the bond market too, depending on how close you are to retirement. And our last benefits is that investing in index funds are low cost. So yes, there is a cost to buying into an index fund, but there are typically pennies on the dollar to own an index fund. That's really cheap compared to maybe hiring someone that you are blindly putting your faith in to manage your money and paying them large fees annually. Well, you can do the exact same thing that they would do for pennies on the dollar. So yes, there are small fees called expense ratios attached to most index funds, but they're very, very low. Imagine the benefit of all this diversification and growth versus what you have to pay. So it's a really good trade-off in my opinion. Now, those are the 5 benefits of why investing in index funds are a superior option to investing in individual stocks. But before we depart, let's talk about how do you buy index funds? Well, the great thing is that you can buy an index fund just like you would buy any individual stocks. All right. So you can go to your stock portfolio and look up an index fund and invest in it. If you read below, I'll have a list of very popular index funds that are low cost that you can consider adding to your stock portfolio.